Welcome, everybody. I'm Vern Cushenberry, your Chief Investment Officer. And wow, what a quarter. I have an update for you. But just real quick, I serve as the head of our investment committee. I've been doing this for a long time now. I think I'm going on 27 years and connect with over 100 advisors nationwide that we support to build retirement plans and other resources. And these quarterly updates are designed to keep all of our constituents on track. So I'm going to jump into it, but I always like to encourage questions. I'm available period for anything that you'd like to know more about. Please connect with me. We can go take a deeper dive into any of this information. But like I said, what a volatile quarter. We started off with the Liberation Day tariffs, and that caused a 9% sell-off in the market. What we're looking at here is just the graph of the quarter. This is the MSCI All Country World Index. So this is global stock returns. Very volatile. We've filmed a video to put out to our clients, and we basically said, you know, if you take these tariffs at face value, they represent a very large tax increase, and it's likely to be a tough go. The flip side of that coin was that the market was anticipating that the face value, or I guess the headline risk of the tariffs would be much smaller, and we have had subsequent negotiations that have given the market clarity, and we've seen a rise in the stock market. But we also saw some incredible turmoil in the Middle East, so I'm going to try to put some color on that. And then just here in the last week, we saw the one big beautiful bill that's going to add $2 to $3 trillion to our national deficit. So we need to talk about that too. Let's jump into it. Here we are on tariffs. Like I said, this is where we started the quarter. And let me see here. Okay, so if you look back on April the 8th, we were looking at a potential 30% tariff relative to historical tariffs. That takes us all the way back to the beginning of this last century, really. So nobody thought that number would probably hold, but it was really, to what degree are we going to see these tariffs? And subsequent renegotiations over the last quarter have given the market a little bit of confidence. But I will say this, we haven't seen enough time pass for the impacts of these tariffs to trickle through to the data. So there's still risk on the table. Here's June 3rd. As of June 30th, we have an average net tariff impact of about 15%. That still takes us back to the early 19th century. I opened the last video with a little vignette, a little clip on the Smoot-Hawley Tariff Act. And I mentioned that did not go well. That was not received well by the markets and led us into the Great Depression. We have a lot of things going for us today, primarily the Federal Reserve that helps manage some of those building potential negative imbalances. And I think we'll see this number come off maybe just a little bit if we see more future trade deals. But this does create a lot of uncertainty in the marketplace. Moving on to turmoil in the Middle East, this is impossible to know how this is going to unfold. But I do have this slide. I shared it last quarter, but it's definitely worth another share because if we look at geopolitical tensions of the last 50 years, it does give us something to compare to and add some historical perspective. So what you can see here, just by averaging different time periods that include the Cuban Missile Crisis, the Iraq War, the Arab Spring, the Iranian hostage crisis, and a few others, if we look at the average total return 6 months from the event, the markets have typically rallied by 5%. And if we look at the average total return 12 months from the event, the markets have typically averaged by 8%. And I try to shoot these videos with a common formula. I try to address the concerns of the day and then subtly shift all investors' attention back to some common sense, timeless wisdom. And that sounds the same every quarter because it is the same. Rarely is there anything new in the world of finance, and there's nothing new in the world of finance this quarter either that is going to affect your financial plan. Stay the course, stick to a well thought out financial plan, and that's going to create the best outcomes over time. And that's the message here as well. Okay, lastly, the one big beautiful bill. We saw a jump in the markets after that was passed. Like I said, we are at all-time highs. That will take our Federal deficit up another 2.5 to 3 trillion, depending on how you forecast the numbers. Here's the CBO. Let me see if I can zoom in on this a little bit. You can see the forecast of federal debt to GDP. That's what we're looking at here on the bottom right-hand side of the screen. Federal net debt to GDP. That's the ratio that we monitor over time. Let's see, in 2024, that ratio was at 97, call it 98%. The Congressional Budget Office forecasts that ratio to rise from 98% to 117%. That was before the One Big Beautiful Bill. After the One Big Beautiful Bill, the Congressional Budget Office forecasts that ratio to rise to 122%. That is very, very high. Those are numbers that we haven't seen in the last century. Really, any historical precedent, you'd have to go back to the World War II and subsequent to that. That will create a drag on the economy. So we basically just kicked the can forward. We're on an unsustainable trajectory. This will have consequences. The market will lose confidence in the dollar, or we will be forced to raise taxes in the future, or we will be forced to lower deficits in the future. So the market's having a very positive reaction to this news at the moment because it creates perceived certainty for investment. Pardon me, let me go back to the slide. It creates perceived certainty for investment. It creates perceived certainty for corporate taxes, and that's a good thing for earnings. And it's a good thing for the markets in the short run. But like I said, in the longer run, taxes will have to be higher, benefits will have to be lower, and that serves as a drag on the economy. So where does that leave us? Well, let's look at this valuation chart that I share every quarter. If you look at the S&P 500, this quarter took valuations back up over what we would consider a historically expensive range. We're at about 22 times earnings. If you look at the historical average, that's about 17 times earnings. And anything that we would be considered cheap would be down here around 13 times earnings. So the market is looking at the future with a very, just call it rose-colored glasses. Well, let's zoom out to that 50,000 foot perspective that we try to keep our eye on. And we have identified similar markets over the last 50 years here on this chart. And bear with me, let's look at this one over here on the right. What we have is the forward PE. So that's that price to earnings ratio that was on the last chart. We were at about 22 times. So here we are at about 22 times. Well, what we've charted here is that PE ratio on the horizontal axis. So we're down around here about 22 times. And on the vertical axis, we've charted subsequent 5-year returns. So you can see this line of fit, so to speak. We have a lot of noise in this data, but generally speaking, you can see a relationship. As the markets get more expensive, meaning as those dots end up out here on the right-hand side of the chart, they tend to go down a little bit, which means that the subsequent 5-year returns are lower than they are during periods where the market is cheaper. And I think that's pretty intuitive, but I'm hopeful that this chart allows for investors to get a better visualization of what they might expect in the future. So now you might say, okay, Vern, what's that mean for my own personal portfolio? Well, if you've chartered a good course with your financial planner, this may mean nothing. But as I say to every new investor I talk to, if you don't have a goal in mind, then you shouldn't be taking on any risk in the first place. Investing is inherently risky, and you need to understand why you're taking that risk. So in a market like we just came through, with markets at all-time highs, you're closer to accomplishing your goal. With the help of your financial planner, you can revisit that plan and potentially take risk off the table, because as you get closer to accomplishing your goal, or maybe you've accomplished it, you should be taking risk off the table. We held a webinar this quarter for some of our institutional clients, and we're seeing more and more interest in not a new investment, but it's becoming more and more prevalent because of financial technology has advanced to the point where we've solved certain issues that allow us to gain distribution. These are structured notes. You also hear a sister investment or similar investment called buffered exchange traded funds. And these can allow investors to address the downside risk associated with the investments in their portfolio while simultaneously capturing some of the upside. So I'm going to include a link to this webinar. These are sophisticated. These have very unique use cases, but they do apply to some individual investors as well. So I'm going to include a link to this webinar. If that's something you'd like to learn more about, reach out to me, reach out to your financial planner. As I mentioned, we're always here to answer questions. I love answering questions. It means that people are tuning in and they're paying attention, and that always creates better outcomes. So thanks for your time. I appreciate it. And I'll be back in another quarter with another market update.